And obviously market participants need to be very careful because it's absolutely not priced, right? So it's always surprising stuff that can really move markets.
Jens, you said earlier that one of the key differences or what could drive inflation would be persistently stimulative fiscal policy. You know, of course, we're finding out, getting details on a possible stimulus right now. We don't know if it's going to go anywhere, but it's also a one-off, 700 billion, 900 billion. It's a lot of money, and then presumably we sort of go back to fiscal policy as normal. Does a one-off do it, or would it really have to be a meaningful change in how we approach fiscal policy to actually get a change in the inflation trajectory?
I think that persistence is very, very key, and I think you will find that a lot of the key economic voices within the new Biden administration sort of have learned the lesson from the post-global financial crisis period, in that you don't want to take back the stimulus too early. Right. This is a key lesson. We are seeing it in Europe as well, right? In Europe, they're sort of famous for having a tight fiscal framework within the Maastricht Treaty. The Maastricht Treaty is disabled in Europe officially. You don't have to obey the fiscal rules this year and next year either. So they want to generate some persistency in the fiscal stimulus there. So it's part of this framework where fiscal policy is getting more emphasis, and rightly so. And I think you're absolutely right to point out to the consistency. And I would point out that in the U.S., this sort of lame duck stimulus is important to give the economy momentum, but it's not viewed as the last bit, right? So we have a new administration coming in, right, and presumably they'll be very aggressive, like infrastructure is a big thing. That's going to come online later on.
All right, our thanks to Jens Nordvig, Exante Data founder and CEO. Go check out the new newsletter, Money Inside It Out. Lots of provocative arguments there. Coming up, the last Fed decision of the year set for Wednesday. We take a look at the macro look for 2021 with John Turek, the author of the Cheap Convexity blog. That's next. This is Bloomberg.
today our focus is on stimulus, as bipartisan lawmakers unveiled this hour, well, the previous hour, that the latest attempt to try and break that deadlock on aid talks. The Fed this week will be meeting as they decide to how they will approach the economy in the year ahead. Joe, for the market during this time, we have seen this simultaneous risk-on rally in the stocks and break-evens at the same time, which sort of feels odd.
No, it's pretty striking. I mean, we've really seen this sort of you can see the reflation in the market very clearly what's going on. This incredible stock market recovery, that's the white line. The orange line on the chart, 10-year break-evens with increased expectations for inflation over the coming years. It works out really well, and you can really see what is driving stocks. So then, of course, the question is, can it go further? So joining us for more on this question is John Turek. He's the author of the Cheap Convexity blog. John, we've seen this reflation. Can it continue? I mean, we see 10-year break-evens getting close to 1.9 or 2%. Can it go further, and is that an important precondition for ongoing stock market rally?
Yeah, hi, how are you guys? Thanks for having me on. I think it can continue, because one of the things that's very interesting about what will be this recovery as opposed to recoveries in the past is that it's something that the Fed is going to lean into probably a lot more than it traditionally has. And given the fact that we're kind of pinned at zero across the bond market, I think it allows for this natural inherent expansion in the range of where asset markets can trade, whether that's in FX or in equities. So I think really the key will be, in terms of, allowing this pretty monster inflationary rally to continue, is for the Fed to maintain and reaffirm that its new reaction function is here to stay.
But do you think that that's realistic? Because at the end of the day, I mean, if you believe what Powell and the Fed have been saying, there is still an inflation reaction that they would have should you actually start to see it materialize in a meaningful way. We can argue about how long that would take, but at some point you would think the Fed's hand would be forced.
Yeah, I mean, I think one of the potentially interesting narratives going into next year is that this Q2, Q3 boom, and does that set up a cage match between the Fed's new average inflation targeting metrics versus the potential upside risks, which are considerable, given that the current Fed dot for growth next year is around 4%, which will probably end up being quite low. And I think actually is that the Fed's resolve in terms of enforcing their new reaction function may surprise people. I mean, Governor Brainard, in his speech in February, which predates kind of the COVID shock, came up with this idea of opportunistic reflation, which in a sense would be the Fed leaning into these, outsized temporary inflationary moves, and kind of using that as a mechanism to get, both to their goals and inflation expectations back anchored at 2%.
Cage fight. I love that. It sort of speaks slightly to, we talk about it a lot, the inequality that is being so painfully obvious as we resuscitate this economy. And it's something that we heard Jay Powell speak about even prior to the COVID, the fact that driving unemployment quite so low started to mean that more and more people were benefiting. Does the fact that Joe Biden is looking to put that upon Jay Powell, that some sort of role of the Federal Reserve in helping drive down inequality, could we see that even more add credence to the fact that this is going to be an economy that's allowed to run hot?
Yeah, I think that's a very good point. I mean, I think one of the things that's very interesting about the Fed's current reaction function is that the Fed listens events, and the Fed strategic review kind of really predates COVID, and they were ready on this path of trying to reinforce a hot economy, and one where basically policy can pro-cyclically expand, which means that as the economy recovers, by saying that there's so many barriers to tightening and then that they have no interest in tightening, that actually allows the stance of policy to expand via real interest rates. And that's kind of what we've seen so far this year in the reflation rallies. You've had this divide between real yields kind of inching lower and break even shooting higher. And I think that's a testament to the fact that the market does believe that this reaction function is here to stay, and the Fed is serious about it. And I think further progress on the fiscal front will only add credence to the fact that this recovery may look different than the 2009-2010 one.
John, as you mentioned, we expect to see some sort of economic boom in Q2,